Today we take a look at something I call the index eclipse on Tesla stock in honor of the eclipse that just happened a few days ago. In essence, Tesla stock price is at or above where it was before the lower production numbers were announced. And the question is, well, why is that? This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters. If you enjoy the show, would like some better ideas on investing and trading, please join us on Patreon, and like and subscribe would be appreciated. So we did a show several weeks back, and what we were focused on is the fact that as you look at how indices or indexes are supposed to work, the whole idea is, let's say you have the S&P, and let's say you have a company like NVIDIA that jumps from a $1 trillion in value to $2 trillion in value. Well, what happens there is that we actually have other companies that are within the S&P, their weighting is being reduced because of the increase in value of another company within that environment. So the open question that came up was, well, wait a second, Tesla should get punished, not huge, maybe 5 to 10%, because as we do the rebalancing of the indices, we see a dip in Tesla stock price to reflect the power of NVIDIA within the S&P 500. So, my estimation was we'd see a 5 to 10 point drop that would occur there. And obviously, we saw a temporary drop, but kind of a roam back to the 175-ish plus or minus 4 points. So in our latest sort of what's going on here with Tesla, something popped up that I think is worth your time to note. And that is that Tesla just announced an 8.5% drop in revenue. And this added to it would say that both profit and revenue would fall by that amount. So there's some really smart people around the world that focus on all this data, and I expect we'll see a temporary dip in the stock price as we get earnings that go with how this story is going to be told, as well as obviously the forward look of what Elon is doing. So the issue that comes up today that I stumbled across that I thought was really interesting is something I'm calling an eclipse by Tesla's stock price. So what happened is that I check Tesla's stock price at least once a day, maybe several if things are heavily happening, to see what the news is that's driving the stock. So one of the things I glanced at, noticed this week was, please go into any of your services. I use Google a lot to look. I'll also use Yahoo to glance at the stock price. Please go in and take a look at what will happen is when you get the stock price, after you see the stock price, if you scroll further down, there's a list of the largest holders of Tesla. And then what you want to do when you get there is just scroll down that list to see the largest individual owners of shares. So one of the things that I was kind of shocked by is, and hence the show, and I think it's influencing Tesla's stock price dramatically right now, is something that it turns out that beyond Elon Musk, the next two largest holders of Tesla shares are two index funds from Vanguard. And so why is this a big deal? Well, it was my thought that what would happen is, to Tesla, is all the NVIDIAs and the other firms that have become huge as people anticipate their impact on the marketplace. There's been kind of a shift going on here. And what I expected to happen was Tesla gets pushed back simply because it's not one of those key stocks. Well, as you take a look at the other large holders, which are indices or index funds where they are forced to buy the stock, there's another phenomenon that's interesting here that I think is going on, and what that is sort of an index eclipse, complements of the rest of the index funds to the benefit of Tesla. So let's go back 2 years. You may recall that prior to the S&P 500 entry by Tesla, we would see wild swings in the stock price driven by new sentiment relative to like the 420, potentially the acquisition, or on a quarterly basis, as we got earnings either very good or very bad, we'd see very dramatic moves. So an incident like what just happened with an 8.5% drop in revenue would immediately trigger a sell-off of Tesla, at least 10%, maybe even 20%, once people realize that not only have Tesla been cutting prices to increase sales, but that those sales were down 8.5%. So you have both a stock price that's down because revenue is down, and it's down because earnings will be down in a double dip fashion. Both the margins are going to be lower and the earnings are lower simply because you're selling fewer vehicles. So all of this says, wait a second, we've got a pileup of news that is relatively negative on Tesla. But guess what? There are ways in which the market sort of develops new behavior that can surprise and cause things go in directions that were unexpected. In this case, what I want to introduce is the fact that beyond the S&P 500 index, there are other indices that are offered by Vanguard that are actually picking up the shares that their S&P fund are getting rid of, and other people's S&P fund as well. So, like, how does that make any sense at all? Well, something has happened, and we've talked about this before, where we went to the world of what's called mutual funds. So people are like, why take the risk for my retirement account or where I put my money while I'm in the retirement fund? I can choose, let's say, this success of Peter Lynch with Fidelity really prompted a lot of people to say, forget about me picking individual stocks. It's safer in a mutual fund, and I can just ship it out there and everything is great. What then happened was that somewhat of a shift occurred where people are like, well, wait a second, why should I mess with a mutual fund? It's great that a mutual fund like Fidelity is generating really nice returns. But the problem is that if their fee is so high that it wipes out a third or a half of what I'm earning on the mutual fund, the real return I'm experiencing is a lot lower. So therefore, people are like, I'm out of the mutual fund game. I want to find another game where I can get my returns as I would a mutual fund, but I want my fee structure to be low enough so I can make some money. Hence the index. So the king of the index obviously is John Bogle's Vanguard. And what I'm seeing right now, and I look forward to your comments on this, is that, so what then happened is we moved away from mutual funds sort of dominating. We move on to index funds dominating, with S&P being sort of the most dominating entity here. So the next question that pops up then is, well, what impact do these guys have, and what does it mean? Well, you'll notice that the third largest hire or owner of Tesla stock is actually one of the index funds by Bogle, but not the S&P. And so this, I think, is really fascinating because Tesla, I'm not saying Tesla's in old age right now because we have the semi coming and there are other things that are generate nice revenue. But something really fun is happening right now, which is that the S&P was so successful that a process emerged. And what that process is that people were saying, okay, I like the S&P, it does a great job, but I want to carve out away from the S&P. So I want to say, yes, we can be the S&P for you, that's low cost, but why don't we do carve outs where we take the S&P, look for where the growth is as in technology. Um, so we want sort of safety, but we want the growth of technology. So now you have these new funds, all these new funds that were created that are beyond the S&P, and those funds have different parameters. And guess what? Those parameters include companies like Tesla. It's a large cap company, which means that I think small cap is between 100 million in market cap and a billion. Tesla is way above that. But there are all these interesting terms like there's something called big cap growth. So it's a big capitalization stock price. It has growth going on. So therefore it goes into this S&P fund. There's also one called, obviously the NASDAQ 100, another index that's tracking the fact that NASDAQ tends to have better growth than the Dow's stocks. And, it's an index fund that has a lot of money in it. So in Tesla's middle age, as it's entered the S&P, it's my argument that we're now in this very interesting space where, guess what? Tesla might not qualify anymore to sit as the largest company, one of the largest companies in the world, or above $1 trillion in market cap. But guess what? There are indices that Tesla is still a significant player in, and it's possible those people are acquiring shares when other indices might be saying we want to reduce our weighting because it's not as big as it was. So therefore, what I think we may see happen with the earnings we're going to get coming up in a week or so, I think we may actually end up with Tesla stock price going sideways or slightly up, driven by the reallocation that's going on where one Vanguard fund can say, we got to reduce our weighting to you, but some of the other new funds they've created to take advantage of market demand for those activities could say, hey, we'll buy those from you because the parameters of the company fit what we need for our index. And so there are, the S&P has done a good job of expanding the number of funds that they will strictly allow, but then chasing good returns for people with the parameters of the S&P, there have been a lot of offshoot entities that have been building these funds that have large amounts of dollars in them right now that actually are acquiring Tesla while other people are selling them. And we've also discussed the fact that when the market starts to rise, we also have the problem of something called PE expansion. So I don't think that's the case going on right here because Tesla's PE is actually falling. But the whole idea is this. Let's say in the last 100 years, the average PE for the market, let's say, I was told it's 14. This is for the whole market. And so it could be so if that's the average, what a value investor will do is say, okay, the market's 100-year PE is 14. Now, we're running out of things to buy. The companies that we really want to buy, Microsoft and Nvidia, all these companies are doing great, but their PEs have gotten beyond what we're comfortable on if we're a value investor. So therefore, they're saying we're going to sell that and we're going to go ahead and buy PEs for companies that are closer to what a historical norm might be for a company. So I bring this other sort of PE-based discussion to you because no, Tesla's not doing blazing digits, but it is a big cap company, i.e. Above $1 billion, multiple billions plus. And it does change in value, but there's safety in the size that the company is at because you can see those revenues and profits, et cetera. So this is a really interesting position because while I'm expecting the stock to get smashed based on the parameters that were used a year, 2, 3 ago, the exact same behavior is occurring and the company is going sideways and in some cases slightly up. So I would argue that don't be surprised if everybody knew the stock price would be down, et cetera, But with this index issue and the expansion of PEs and the willingness of buyers hunting for buying something rather than sitting there in cash and getting no return for investors, do not be surprised if we see this kind of move go on more. So we definitely look forward to your opinion on this. And I basically very much look forward to comments. And I want to thank all of you in New York. I see there's a lot of investors and analysts that actually watch the show. We appreciate your doing so. Please give us a thumbs up and a comment if you would, because I think this is really interesting. At any rate, this is the end of our formal discussion of Tesla. I wanted to next move back to our health tips again. I just wanted to note that one of the health tips that I'm really concentrating on figuring out right now is I ran into a kidney doctor and he informed me that really you should have 3 days a week at least where you have no meat. The reason for that is that I thought your kidneys just got used to their work that they were doing on the meat to digest, but it turns out that nope. The reality is that you get a tired kidney. It doesn't strengthen in any way. So by giving your kidney a break 2-3 times a week, you're now able to help take care of it so it can have rest and then go back to work once you do eat meat on those off days. So I've been trying this out. I would have to say there are little signs that I think this is working. I wanted to encourage you to try it as well. The best way I've found to make sure you're not malnutritious or starving during those other days, I found is pre-bagged salads that I've been getting in our area. There's Aldi's, there's TJ Maxx, even the main grocery stores have them, or say Trader Joe's. All of them are carrying these salads. I deliberately encourage you to avoid the ones with lettuce in the bag. Try to focus on kale, all the other things, because I just feel like it's a way better use of your dollar and time, because nutritional value on the lettuce side, I think, is kind of low. So I wanted to encourage you to try this out. Go for the healthier side in terms of like a balsamic vinaigrette, or just go on the healthier side in terms of what you're using there. At any rate, look forward to your comments on all of this. We also know there are health professionals that watch our show. Please take time to share your ideas as well. This is Greg for Teslafaninsight. Tschüss, au revoir. Lahith Hoda Hafestrazi, Ni Hao Mo, Kumbawa, Namaste. And in Jamaica, we say enough respect, walk good man. Thanks for joining us. Have a good day. Arrivederci.